Welcome, ladies and gentlemen. I'm David Sung, President of Nicola Wealth, and I'll be your host today. Before we begin, I would like to touch on some quick housekeeping. If this is your first online event with us this year, you will notice that we are using a new platform today. Should you wish to submit a question, please use the Ask a Question tool located below the live video feed. If you wish to add subtitles to this video, make sure to click the closed caption button in the bottom right corner of the live video and turn them on. If you have any questions about the platform or need assistance, please use the Ask a Question button to connect with our team, or alternatively, click the question mark at the bottom of the screen for some troubleshooting. Now, I'm very excited for today's discussion. In previous years, our Strategic Outlook has featured our Chairman and CEO, John Nicola, and our Chief Investment Officer, Rob Edel, presenting on how they see the economic landscape of the year ahead and how to plan your investment strategy. This year, we're expanding our format. Presenting along with myself, John, and Rob, we will be joined by Mark Hanna, Managing Director of Nicola Wealth Real Estate, and Bijal Patel, CFO and Head of Private Capital at Nicola Wealth, as they share their views in their respective asset classes for 2022. Now, I'm glad to have such a deep lineup available to us today, as we have no shortage of topics to discuss. Chief among them, how the world will look post-COVID, as vaccination rates rise across the world and case counts continue to decline. And of course, the geopolitical issues in Eastern Europe. When we held our market outlook last year, the global pandemic dominated headlines and disrupted our lives. We were almost a year into lockdowns, the dust was just beginning to settle on Brexit, the US election ultimately brought in a new president and new Congress, and civil unrest and political upheaval were all having tangible impacts on markets. And now, inflation, rising central bank rates, the continued uncertainty surrounding the coronavirus, and Russia's invasion of Ukraine are all the biggest fears impacting the markets so far in 2022. And it's only March 1st. These issues are understandably causing concerns for investors. How do I know this? Because the news keeps telling me so. The sensationalism of today's headlines seems to be at an all-time high. Now, I'm not dismissing any of these as issues, but we are bombarded and are constantly being told to be terrified of this impending crisis, or we're being preyed upon for our irrational fear of missing out on that new trend. Already this year, the word COVID has appeared in over 1 million headlines in Canada and the US, the word Russia over 200,000, and inflation over 120,000 times. We're told that we either own too much of the market because it is going down, or we own too little because markets are going up. It has reached a point where we are inundated by so much information surrounding our financial well-being that it is almost impossible for the average consumer to reconcile that information. This leads investors to make irrational decisions and often erodes their confidence in their long-term financial outlook. Without necessarily thinking clearly, investors want to answer the question, what does what I am seeing right now mean for me and my family's financial future, and what action should I quickly take right now to either protect or grow my assets? Now, it's human nature, but it is also human to let fear and greed cloud one's judgment. Established economic theory suggests individuals are well-informed and consistent in their decision-making. It holds that investors are rational, and that when individuals receive new information, they update their beliefs correctly, and then they make choices that are acceptable. While this theory is appealing, in reality, humans do not always act rationally. They don't buy low and sell high, as classical economics said they would. They often do the opposite, and they buy high and sell low. Investors are human, and it is not surprising that financial markets reflect human frailties. Irrational investor behavior can be triggered by a wide range of sources: overconfidence, recency and attention bias, negative market experiences, and fear-inducing headlines. And I think we can all agree from watching our TVs, phones, and iPads over the past few days, with Russia's invasion of Ukraine, there are no shortage of unsettling events going on in the world right now. Fear is extremely potent as a deterrent. Fear of a loss is much greater than pleasure from a gain is one of the key insights of behavioral economics. The phenomenon of fear and greed with investing is not new. For over 25 years, financial services market research firm Dalbar has released its Quantitative Analysis of Investor Behavior report, which measures how investors and on how the decisions that investors make affect their long-term portfolio performance. Dalbar research shows that investors consistently buy high and sell low. On average, investors lose 2% per year due to buying high and selling low versus buying and holding. Now, over the past 20 years, the investors in the Dalbar study earned a net return that was 2% per year below than if they had never made a single change to their account over those 20 years. A loss of 2% is significant. As a simple example, $1 million invested at a 4% return due to bad investor behavior versus a 6% annualized return difference amounts to $1 million over 20 years, or 46% more money, for doing nothing and not being your own worst enemy. But investors did not do nothing. They reacted and made tactical and market timing decisions to their own detriment. Put simply, volatility brings on bad investor behavior. Being human, it's hard not to make changes in the face of volatility and perceived threats to one's wealth. That is why we believe in an approach that is practiced by the world's best performing institutional pensions and sovereign wealth funds. An approach that substantially reduces exposure to volatile public markets and is diversified into the ownership of hard asset commercial real estate, the ownership of profitable private businesses, private debt, as well as allocations to private commercial mortgages, infrastructure, and other private assets. Over the past 20 years, taking into account the dot-com bubble, the 2008 global financial crisis, the European debt crisis, and the COVID pandemic, our clients have experienced an annualized compounded return result of 7.09%, well in excess of North American and world stock market indexes. And this is done with significantly less volatility. And well above, in fact, almost 3% per year above a traditional 60-40 balanced stock and bond portfolio, which is how most investors have their capital invested. Now, of note here, and as the Dalbar study pointed out, investors also do not earn the stock market benchmark returns. They've earned the benchmark returns minus another 2% due to bad investor behavior. But wealth management is more than investment returns. And while our appetite for innovation, one of our core values, remains constant, we also remain focused on our core mission: to work closely with our clients to understand your aspirations, to build, grow, and protect your wealth, to leave a lasting legacy for your families, your community, and the philanthropic causes you care about. Each of you is unique, and that is why, from our perspective, everything starts with planning. Our goal is to understand where you are in the financial life cycle and what you need to plan for. We begin with the end goal in mind. Now, we don't believe in having a single conversation. Planning is an ongoing process, a series of conversations that address the shifting nature of issues and the unknowns our clients face at varying stages of their lives. We understand that wealth is much more than just money, and the harsh reality of the global pandemic has encouraged families to focus on ensuring stability and longevity throughout their financial journeys. We will continue to seek to guide conversations with our clients, sometimes down a difficult path, to uncover the things that matter most to you. Consider these financial planning questions. Is your investment portfolio protected from volatility? Do you know how much capital you will require to meet your retirement goals? Have you considered how you will create your legacy? Is your insurance positioned as an asset class and integrated with your investment strategy? Have you prepared your family to manage this wealth? Have you reviewed loans and mortgages to reduce interest costs and determine whether any of those may be tax deductible? Do you have a succession plan in place? And is your plan being regularly reviewed and adjusted to ensure you're on track? Now, boiling it down to one sentence, at Nicola Wealth, our purpose is to share our expertise and best skills to help you achieve the goals and the legacies that matter. Please welcome to the stage, or should I say your screen, our Chairman and CEO, John Nicola.
Well, thank you, David, and good morning, everybody. We have an opportunity here to take a look at some information that I put together in a newsletter about a couple of months ago. It was related to the Charles Dickens book, A Tale of Two Cities. And the reason I chose this book was because of the way it starts. The words at the beginning of the book go something like this. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief. It was the epoch of incredulity. It was the season of light. It was a season of darkness. It was the spring of hope. It was the winter of despair. Now, another way of looking at this is to say that it's effectively looking at the situation that we have today as a glass half full or a glass half empty. So let's look at what the glass half full would suggest. First off, public markets and residential real estate are at almost all-time highs in many, many markets around the world. COVID vaccines have been developed in record time, and the fourth wave of COVID, Omicron, is less deadly and less serious illness than other versions have been. The move to ESG investments has increased rapidly. Climate change is front and center, and the cost of renewable energy is improving exponentially. The significant drops in the levels of global poverty, hunger, and illiteracy. There's a great book out called 10 Global Trends by Marshall Tooby, and it is definitely worth taking a look at. Global population increases are slowing rapidly. In fact, they're expected to peak at around 8.9 billion within 30 years, and after that, global populations will start to decline. And any rises in interest rates are likely to be measured and spread out over time. Their impact on asset classes will be modest. Now, that's how it looks if your glass is half full. That's not how it looks if your glass is half empty. Huge increases in corporate and government debt to finance the pandemic and the acquisition of assets, such as the Evergrande issues and real estate debt bubble that exists in China today. The end result could be a combination of higher inflation and corporate defaults. Geopolitical tensions, obviously, such as we see between China and the U.S., and most importantly today, between Russia and the Ukraine. Functional politics, the rise of populism, specifically in the U.S., but other countries as well. Equity prices, especially in the U.S., are at very high levels, almost record levels. Faster infectious rates for Omicron lead to new lockdowns globally. Markets this year are negative in most areas of the world, in terms of public markets at least. And higher interest rates and inflation, they're going to have a major impact on residential housing. So, glass half full, glass half empty. Where does that take us? Are happy days here again, or are we going to see who prevails, the bulls or the bears? So that's worthy of having a discussion about. At the end of last year, for example, everything looked quite rosy. The TSX was up 19%, as was the New York Stock Exchange. The FTSE index in London, 16%. Only the Hang Seng was down 15%, and the major reason for that was the interference of the Chinese government with respect to specifically technology companies like Alibaba and Tencent and Didi. And the Euro Stoxx was up 11%. But when we take a look at what's happened in the first 2 months of 2022, things don't look nearly the same. The S&P is off 9%. The NASDAQ almost in bear territory at -16%. The Russell 2000 is -18%. The TSX has done much better, primarily as a result of very strong financials and energy prices, which have been beneficial to a lot of Canadian companies. The Euro Stoxx is off 10%, and the Hang Seng is down another 25% from the 15% it lost last year. So let's take a look at what's going on specifically with the area of the NASDAQ. You know, the question is this .com 2.0? For those of you who don't remember, the dot-com bubble started in 2000, and by the time it finished in 2002, 2003, the NASDAQ managed to lose about 75% of its value and did not recover that until 2017. So it took 17 years to get back to where it was originally at the beginning of the 21st century. So what do we have here? Well, major companies have not dropped much, but they have dropped. Apple is down 8%, Microsoft 15%, and Amazon 18%. Other companies have taken a much bigger hit, like Tesla at 30%, Facebook, or now Meta, at 46%, and our Canadian contribution to the high-tech world, Shopify, is down 61% from its peak just a few months ago. Let's take a look at what's going on geopolitically. We know there's a war going on between Ukraine and Russia. I think most people are clearly on the side of the Ukraine, but of course they are outgunned, and they may not be outmatched, and it's going to be very difficult to see how this plays out. As we speak, basically negotiations are going on, so we can only be hopeful they are successful. At the same time, the question about what China will do with Taiwan, whether it stays out of the any engagement with them, or whether it takes a look at what's going on between Russia and the Ukraine and says, that gives me a license to take over Taiwan because I consider it part of China. So this is the deadly duo. From a Russian perspective, they have the war in the Ukraine. The question is going to be, are the sanctions strong enough without SWIFT and blocking all trade, including energy? So SWIFT has now been put into play, but energy trade with Russia will continue. Strong military, but a weak economy. It may surprise most of you to know that Russia's total economy is actually smaller than Canada, even though they have 4 times the population. And that population is declining as well, which we're going to look at in a little bit. With China, severe declines in property market and developers. The amount of debt that's accumulated is staggering, and the amount of overbuilding has been huge, especially in residential real estate. Will Taiwan be invaded if Russia takes the Ukraine is a question mark. And command and control over technology companies. Tencent, Alibaba, and Didi are down between 40 and 75% in a single year as a result of the restrictions put on them by the Chinese Communist Party. And China also has a declining population, which we'll look at in a minute. If you want to get a better handle on what's going on in the Ukraine, I can't recommend this video enough. Somebody forwarded it to me. It's by a woman named Palki Sharma, and she works for a group called Gravitas Plus. It's on YouTube. It's about 9-10 minutes long, and it gives a great perspective of Ukrainian history and the relationship between the Ukraine and Russia over the last 1,000 years. And maybe helps explain part of the reason we are where we are today. So let's take a look at future from the perspective of expected returns. About 6 or 7 months ago, we put together a newsletter called Born Under a Bad Sign, using a song title by Albert King that came out in the late 60s, and in which he said, if it wasn't for bad luck, I wouldn't have no luck at all. So we took a look at this from a different perspective, because in the last decade, especially up to when COVID became a significant factor in our lives, essentially asset prices had been rising across the board significantly for well over a decade. And these companies were asked in early 2021 to comment on what the next decade would look like. This includes BlackRock, JP Morgan, Morningstar, Research Affiliates, and Vanguard. And they came up with estimates for U.S. equities, developed market equities, emerging market equities, and U.S. bonds as a portfolio. And they put it together in terms of what their expected returns were and what that average looked like. And as you can see, the averages are not massively impressive. Keeping in mind, these averages are before inflation and costs. So even if we put in modest costs and modest inflation of 2% for inflation and 0.5% for trading costs, essentially you're looking at returns on, let's say, U.S. equities for the group on average at less than 1% a year after inflation. And while developed market equities and emerging market equities are better because they are cheaper currently, the return on bonds is expected to be negative for a decade when inflation is taken into account. Net result, the expected return of this group is for a balanced portfolio to generate a return of about 1.28% over the next decade, net of inflation and fees. And others feel the same way. Credit Suisse came out with a report not shortly after this one came out and said that they think over the next 20 years, returns are going to be for balanced portfolios around 2% net of inflation and fees. So one thing that has happened, though, interestingly, even though markets were very expensive last year, because earnings rose so rapidly, markets today are cheaper than they were a year ago by actually quite a bit. So the American S&P 500 is 30% cheaper today than it was in January of 2021. Some other things to consider, and these are reasons to think of the glass half full aspect of investing, is that the yield, now this isn't the yield on dividends for the S&P 500, this is the earnings yield. It's the inverse of the price earnings ratio. And that's currently around 4% for the S&P 500, and that is 130% higher than it is for 10-year bonds. So that actually is a very healthy spread. You're getting paid a lot higher income return overall with stocks than you are with bonds. And in addition to that, while American stocks are still relatively more expensive, other markets around the world, especially with respect to Europe and emerging countries, are actually considerably cheaper. Now we take a look at interest rates in real estate, because real estate is going to be impacted by what happens with interest rates. Now if we take a look back a number of years ago, 12 years ago, the gap between, you're looking at the gap between government 10-year bond rates and what are called cap rates or income rates on real estate. And that gap was plus or minus around 400 basis points, or 4%. And fast forward to basically just the last quarter of 2021, and essentially that gap is still around 4%. And this is where we would expect it to stay between 4 and 5% over a period of time. So as interest rates rise, and it depends how far they rise, cap rates will rise, and that will actually have some negative impact on the valuations for commercial real estate. So that's when Mark talks about this later. He'll explain how adding value to the real estate you buy today is going to be more critical than it has been in the past. As we move forward, we should be taking a look at inflation. Now, obviously, consumer prices have been rising for more than a year now, and that has caused bond rates to rise as well, but actually not that much. This is a chart of 10-year bond rates, and in the last 6 months, they've gone up, but they've gone up by less than 1%. And when we take a look at around the world, you can see that while Canada and the U.S. are almost at 2% bond rates, other parts of the world, even countries like Italy, which has a much lower credit rating than either Canada or the U.S., the UK, which might be more or less around the same, but Japan, Switzerland, and Germany, their average interest rate on 10-year bonds is less than 1/4%. And in fact, it was negative for all three countries just 6 weeks ago. So interest rates have really not moved. They've moved, but they have not moved that much. You know, when we take a look at the inflation, year-over-year inflation for the U.S. just came in at 7.5% at the end of January, and 5.1% in Canada. Now, we have to keep in mind that these are from very low levels in 2020. In the U.S., inflation was only 1.2% in 2020 and 0.7% in Canada. So in Canada, for example, over the last 2 years, the total collective inflation rate is still roughly less than 6% over 2 years, or roughly about 3% a year. So not excessive, really. There have been supply chain issues, increased demand from government support. That is, the government has generated so much additional cash in society that the ability to buy goods and services has increased. Now the question is this permanent or transitory? Has the trend turned? And a couple of things to look at is this. This is a chart that's a strange one. It takes a look at the spread, that is the gap between 2-year bonds and 10-year bonds. So logically, if I want to borrow money for 10 years, I'd pay a higher interest rate than if I want to borrow money for like 2 years. So I would expect 2-year bonds to be cheaper than 10-year bonds. And you can see here about a year ago, in April of 21, the 2-year bonds were 1.6% cheaper. That is, the interest rate on them was 1.6% less than 10-year bonds. Fast forward to today, that gap has shrunk to about 0.4%. Okay, so when short-term interest rates rise faster than long-term interest rates, something is occurring that potentially puts us closer and closer to a recession. So the way it works is when short-term rates are higher than long durations, the yield curve becomes inverted, and that is typically a precursor to a recession. So this is something we want to keep our eye on because it has been declining for more than a year. Another consideration which should impact all investment decisions is demographics. This is a book put together by Daryl Bricker and John Ibbotson, two Canadians. It's on demographics, and it's called Empty Planet, the Shock of Global Population Decline. And they take issue with the UN estimates of population growth and suggesting the population of the world is growing at a far slower rate than the UN suggests and will peak much, much sooner than the UN suggests, which is around 2100. This graph from Statista gives you a sense of what that looks like. And according to this, by 2100, China's population will basically be cut in half. And India will be the most populous country in the world, but still with 300 million less people than it has today. China's population, which is shown here to be decreasing, has actually started that decline. So this is the first year in which the Chinese population, from official statistics, has declined in a year-over-year basis. Other people actually think that decline has been going on for quite a few years. One of the reasons for that decline includes these three graphs. What do they show? The first graph shows that in China, it works out to be 60% higher cost to raise a child to the age of 18 than it does in Germany. And given that there's a very big difference in income per capita between Germany and China, that is a significant difference. At the same time, there are 40% fewer marriages than there were even 7 years ago in China. And that's as a result of the one-child policy and the tendency basically to, unfortunately, abort female fetuses in favor of having a male in the family. And then now there are something like 30 million males of marriage age more than there are women. And the population decline that's occurred, the births that have declined, this is over the last roughly 30 years, have gone from 25 million births in a single year to about 10 million. That's a massive decline at the birth rate. So even the state-owned Global Times has said by 2040, China will face a much worse situation than Japan, with slow economic growth, soaring aging population, weaker innovation if China fails to improve the fertility rate, which is virtually impossible to do. So these numbers are almost certainly baked in. Russia also doesn't have great demographics, and in this article written by Foreign Affairs, says it does not have the demographics for war. If we take a look at this particular graph, in the last 25 years, the Russian population has decreased, not by a huge amount, but by 2.5 million. But it also declined by 1 million in a single year last year. Now, part of that was due to COVID, and the other part is simply due to poor demographics. And they are trying to actually bring in immigrants into Russia from other Eastern European countries, because if they didn't, their population decline would be much faster than what we see here. Now, if we want to get an idea of what long-term decline in population means to both economic growth and inflation, which I think is critical, let's take a look at this graph. This is Japan. And Japan's population basically has not changed in 30 years. This last year, it lost 500,000 people, and it will lose 20 million in total population before 2050, or by 2050. Now, what's the impact of demographics been on China's GDP and inflation over the last 30 years? And we're going to compare that to the U.S. Well, for starters, you can see here that the GDP in 2021 was actually less than it was in 1995. That's 27 years ago. And in that period of time, the total inflation rate, and this is not per year, this is the cumulative inflation rate over 25 years, has been a change of 5% in the Consumer Price Index. Now let's compare that to the U.S., which over that same period of time has seen its GDP rise by 160%, and as a result of that, its inflation rate, cumulative inflation rate, has gone up by 75% over 25 years. So these two things are very much tied together. Demographics has a huge impact on the economy. Over time, it flattens it out, and therefore a huge impact on the consumer price index. So even though we're looking at a lot more inflation today, an aging population, it basically is a deflationary, has a deflationary impact on all economies. So the reason I mention this is a particular graph which we've all seen. This is the hockey stick graph of human population over the last 10,000 years, and of course all of it has occurred in the last roughly 150 years. But if we look at it a bit more closely, some trends are occurring. So when the population went from 1975 to 1987, it grew at 1.94% per year. In the next decade, it dropped a little bit to 1.88%, then a bit more to 1.53% the next decade. And roughly speaking, in the last 7 years between 2011 and 2019, or 8 years between 2011 and 2019, it's grown by 1.29% a year. And last year, the world population projections are, as of the end of 2021, the growth rate has dropped to 1.03%. It will be below 1% in 2 years' time. And the actual increase in the population each year is now starting to shrink. 81 million net change expected in 2020, but only 77 million by 2023. So we are getting very close to a peak population at a much faster rate than we ever thought was the case before. So there's a great book out. I have not, unfortunately, been able to read it because it hasn't been delivered by Amazon, by our ex-Bank of Canada Chairman, Steve Polis. And Stephen had written this book, and he talks about the 5 tectonic forces in this next age of uncertainty. So aging populations and demographics he sees as number 1, followed by the technology revolution, income inequality, the levels of debt that exist corporately and from a government perspective, and of course climate change. This he sees as overwhelming government, and it's really the responsibility of corporations to step in using stakeholder capitalism and ESG to help resolve. And to this I would have added philanthropy and equality of opportunity, not necessarily outcomes. And I would recommend a second book to go with this one that came out 2 years ago by Simon Sinek called The Infinite Game. So, glass half full, glass half empty. This comes down very simply to the question of asset allocation. At least that is our belief, which is a great segue for me to go to my colleagues and ask them to take over from here. So I would like to introduce Bijal Patel, who is the head of our private capital group, Mark Hanna, who's the managing director of our real estate group, and Rob Edel, who's our chief investment officer and head of our public asset group. So starting first with Rob. Rob, I'm going to hand this over to you. Thanks very much.
Thanks, John. Today we're going to look at what happened in the markets last year, and you can see since the pandemic low to the end of last year, the market's up almost 120%. But if you look at just recently, year to date, the market's kind of rolled over. So we want to look at what was happening the last 2 years, and more specifically, what's happening this year, and whether this is something that we can look forward to the rest of the year. So last year, or in the last 2 years, the 2 drivers of the market and why we saw that big increase and consistent increase. We didn't see a lot of pullbacks in the markets. It was monetary and fiscal policy. The amount, the magnitude, and the speed in which monetary and fiscal policy was used over the last 2 years is why the markets were so strong. But what do we see this year? What do we see in 2022 and going forward? When we look at a survey, a fund manager survey by Bank of America Merrill Lynch, you can see the 2 top risks that they see in 2022 are hawkish central banks and higher inflation. Now, 2 other risks I'll point out, the Russia-Ukraine conflict. This survey was done in early February, so we might see that move higher. And then we also see COVID-19, a declining risk. Now, these are both significant risks, but we're going to maintain that they actually reinforce our 2 main risks, which are inflation and the impact that inflation is going to have on central banks. Now, so let's have a look, a deeper dive into inflation, because that's the key variable that we see over the next year. And you can see supply-demand, it's like moving that couch within a fixed supply. It gets really hard. Now, according to the San Francisco Fed, they actually take and subdivide inflation into inflation that is very COVID sensitive in white and non-COVID sensitive in blue. And you can see a lot of the inflation the San Francisco Fed is identifying is COVID sensitive. This would indicate that inflation should be transitory. A lot of the inflation we're seeing, which is upwards of over 7% last month, should go away with the pandemic. Now, however, a concern that we would have is that the longer that COVID-sensitive inflation takes place, the more it's likely to broaden, and we've seen that. You can see from this that 2/3 of inflation now is running above 4%, 20% is above 10% inflation. So a risk, the longer it takes place, the longer you have that COVID-related supply-demand issues, the more likely inflation is going to broaden. Now, another variable which is going to help the long-term increase of inflation is what we're seeing in the employment market. And you're seeing a lot of people come out of the labor market and lead to higher wage growth. And we can see this, the number of people that have retired is significantly higher than what we were trending before the pandemic. Maybe 1.5 million more people have retired during the pandemic. And we are, however, starting to see some of these people come back. So it's a question, just like in general inflation, is it transitory, is it permanent? It's a debatable question. How much of that is going to end up to be transitory and how much will be permanent? It matters because that's going to have an impact on wage growth, which has tended to move up. Now, the problem with wage growth and why it's very important is that you can see from this Merrill Lynch chart, higher wages lead to higher inflationary expectations. It's the higher inflationary expectations that makes inflation more permanent, leads to this wage price spiral. Now, luckily, you saw that previous chart, that was short-term inflation, because if we look at consumer expectations going out past a year, you can see they decline. So out to 3 years and 5 to 10 years, people don't see inflation that high. You're not seeing that big increase. And why is that? Because people have confidence that central banks are going to do the right thing to control inflation. It's the confidence still that people have in the Federal Reserve, in the Bank of Canada, and the Bank of England and the ECB. Now, why do they have that confidence and how do we see that confidence? You can see this is again from Goldman Sachs. They estimate that the US Federal Reserve this year in 2022 are going to hike interest rates 7 times. Right now, if we look at the market's probably discounting 6 times. Goldman Sachs is even at 7. So the market's saying inflation's high, central banks are on it, and they're going to control inflation. You're not seeing longer-term inflationary expectations move higher. Now, Lassie, however, will point out there's a problem. He's warning us of danger. 2-year bond yields are yielding 1.5%. Why is that a danger? Well, let's look at the bond market. You can see that light gray line is the 2-year. It's up 125 basis points. That's discounting 5 rate hikes. Remember, the market's at 6. Goldman Sachs is at 7. The market, the 2-year, which is a good sort of proxy what's happening with rate hikes, is at 5 hikes. But let's look at the 10-year. It's up only 10 basis points. Why does that matter? Because if we look at the yield curve, it's gotten really flat. And this blue line here is the 10-year minus the 2-year. If a flat yield curve isn't necessarily a bad thing, an inverted yield curve is. It is usually an indicator that a recession will soon follow. So the Federal Reserve has to be careful. They have to be careful on how much they can increase short rates in light of 10-year yields not moving higher. They don't want to invert the yield curve. Now, they do, however, have some other tools they can use in trying to tighten monetary conditions, which is the goal of what they want to do by hiking rates. They want to slow down inflation, and to do that, they need to tighten financial conditions. Now, one of the ways they can do that, and this is, again, from Goldman Sachs, they point out if you look at how you tighten financial conditions, short-term rates, nominal policy rates, and they rate it by a weight, is actually not doesn't have the biggest impact on financial conditions. The two that do, 10-year Treasury yields and corporate credit spreads. By far, these two variables have the greatest impact on financial conditions. So let's see what's happening in these markets. This is a 10-year bond yield, and we just mentioned it hasn't moved up that much over the last 10 months. You can see it has actually moved up considerably over its 12-month average. It's now just over 190, 1.9%. The 12-month average is 1.5%. But let's look at it over 5 years. It actually is just at its 5-year average. Credit spreads, it's the same dynamic. Over a 1-year time frame, credit spreads have actually moved above the 12-month average of 3%. But over 5 years, they actually are only at the 5-year average. So two things to point out with this. One, without even increasing rates, you're starting to see these major factors move, but there's room for them to go up more. And this, rather than maybe policy rates, is what we need to focus on. This is what the Federal Reserve and other central banks are going to try to influence in order to tighten monetary or financial conditions. Now, one of the things and one of the ways they can do that is by trying to rein in liquidity. And they can do that because, again, I mentioned before monetary policy. One of the things the Federal Reserve did is they slashed interest rates to zero. They went from 1.5% down to zero in a very quick period of time. But they also expanded their balance sheet from around $4 trillion to $9 trillion. They bought a lot of treasuries. They bought a lot of mortgages. As they unwind that, they're going to remove liquidity from the market. And that's one way they can try and get those 10-year yields up, because they can sell to the market 10-year bonds, and they can also then, that would move into the credit market as well, and its credit spreads should widen out. Now, what does this mean for investments? It's good for stocks. It's not as good for bonds and cash. Now, in fact, if we look at what's happening in the market in anticipation of this, we can see the flows of money into bond funds has actually turned negative. Same with cash. Money's starting to rotate into stocks. So why is that? Again, yields start to move up. That's going to decrease the price of bonds. Credit spreads move up. Again, that makes bonds and corporate bonds less attractive. We're going to make the argument here today that equities are actually a good hedge on inflation and higher rates. And in fact, if you look over time, and this is from Bloomberg, it shows that over time, when the Federal Reserve is moving interest rates higher, stocks have continued to do pretty well. And in fact, from Strategist, you can see that on average, stocks have moved up almost 7%, 6.5% during times where after the Fed has started to tighten rates. Higher rates aren't necessarily bad for stocks. Now, it's not the same for all stocks, however. What tends to do better? Lower price stocks, stocks that are more sort of geared to economic growth. And if you can see from this chart on the right here from Sanford Bernstein, it points out and takes different stocks by their duration, by how sensitive they are to interest rates. So a high duration stock would be a technology stock where earnings are further down the road. Higher rates are harder on higher duration stocks. And you can see the market has valued those stocks more. Now, what we're seeing in the market right now is those names, as interest rates move higher, are performing poorly in the market, whereas the low duration, the more economically sensitive stocks, the stocks that are more geared to earnings growth and earnings, are outperforming. So those are the names you want to own in this environment. And this chart, again, from Sanford Bernstein, makes this point. And where you're going to get returns going forward in the market, it's not from valuation. Higher interest rates are going to make valuations, it's going to be a headwind for valuations. It's going to be from earnings growth. And you can see the strong correlation over the last 2 years between the S&P 500 and forward earnings growth. And when we look at where we see earnings growth over the next year, it's still quite good, over 9% according to the CIBC. Not as good as what we saw last year, but still very solid growth. So where you should expect to see your value come from over the next year would be in companies that are able to show that earnings growth and not companies that rely on lower interest rates and a higher valuation. Now, this actually is good for active managers versus index and passive managers. Why is that? Because if you're analyzing companies by their earnings, earnings matter again. It's not to do with just lower interest rates. It's, there's more to differentiate a good company from a bad company. This is good for active management. And you can see that you're starting to see that with more money starting to flow into active management. And we have also seen so far this year, active managers are tending to outperform. Bad for index funds, good for active managers. Now, also geography is going to play a part. You want, again, companies that have investments in more cyclical industries. Where can you find that? Well, Canada has a lot of industries and sectors geared to earnings growth and to more cyclical industries, especially energy and materials. So Canada, we think Canada is a good place to be invested right now. Canada has more of what the world wants. And if you look at the S&P or the S&P TSX price earnings ratio, the value of Canadian stocks versus US stocks, Canadian stocks are also a lot cheaper. It's the same for European stocks. You can see this chart showing Europe versus the US in the dark blue and versus German 10-year bond yields. You can see that as 10-year bonds, the yields start to move lower. This was an environment where the US would outperform Europe. We're now seeing yields in Europe turn higher. Again, we would expect this to be good for European stocks versus US stocks. Good for Europe versus the US. Not maybe in the last week, given what's happened in Ukraine, but longer term, again, Europe has more cyclical exposure than you would have in the US. And like Canada, European stocks are also cheaper versus the US. Now, one thing I would say, though, if you listen to that, you think, well, you don't want to be invested in the US. The US is a very big market, and you have to be careful that when you look at that, there are a lot of good companies in the US that are still worthy of investing. And we would point out, again, if we emphasize earnings growth, you can see the dark blue line versus the world ex the US in the lighter blue line. The US has some phenomenal companies that are able to generate higher and higher earnings growth. So don't ignore the US, but look closer. Do the work, buy the good companies. Don't just invest in an index. So to wrap it up, big chill for the market? We don't think so. What we would say the key is going to be an environment of high interest rates, that you want to make sure you're invested in the right types of companies, which we think are more cyclical, maybe more international. The key is always going to be earnings growth. The concern, the longer term concern would be if inflation goes up too much and interest rates have to go up as well, that would tend to curtail economic growth, and that eventually would filter into earnings growth, and that would hurt the entire market. We don't see that for next year, however, and we still think this is a good market for equities. Fixed income more challenged, but from a balanced portfolio point of view, we also believe there are opportunities in fixed income where you still want to keep an exposure. And with that, I'm going to pass it over to Bijal to talk about private assets.
Thank you, Rob, for the introduction. I'm now going to talk a little bit about private capital and Nicola and what we're doing here. First, what are private markets? They're investments in assets that are not typically traded on public exchanges or markets. Here at Nicola, we've got 5 different asset classes that fall within this category. We've got mortgages, infrastructure, private debt, private equity, and venture capital, our newly launched fund. If you look at the risk-return profiles across these categories, what you'll see is mortgages, lowest return potential, but also lowest risk as measured by standard deviation. Spreading up to the top right, where you get venture capital, which offers the highest or greatest return potential, but also the highest risk in terms of standard deviation. So why do people invest in private markets? Really, it's about an attractive way to diversify a portfolio. There's really 5 ways that we can do this, and this is why institutions, by the way, have been investing in this asset class for decades. Some of the institutions have over 20% asset allocation in this market. 1, expansive marketplace. It's a big market. The number of private companies is growing, while the number of public companies continues to decrease. And the absolute number of private companies far exceeds the number of public companies. Transparency of information. By working with private companies directly, you can get access to information that's not readily available with public companies. Exclusivity of deals. By working with private companies directly again, you get access to information and access to work with the private companies in a way that you can structure deals that's most beneficial to investors. Expanded investment horizon, long-term focus. Public companies are often driven by quarterly earnings and analyst expectations. In private markets, you can focus on long-term income generation and long-term strategies to help achieve the greatest value creation. Greater control. With private markets and private investors, you can go in and take governance rights, board seats, work directly with management on value creation. So why doesn't everyone invest in private markets? Why do only institutions historically invest in private markets? There's 3 great barriers for individual investors to invest in private markets. The Nicola Private Capital Value Proposition solves some of these barriers for individual investors. I'll walk you through them. The first one is about diversification. If you're a private investor looking to invest in this asset class, you can do 1 or 2 or 3 assets, but you don't get broad diversification. With our investment pools, which are evergreen in nature, $1 invested in the pool gives you immediate access to all of the investments in there. That can be dozens or hundreds of different investments. Number 2, minimum thresholds. As a private investor looking to invest in this space, you'd often have to write checks for $1 million, $3 million, $5 million. With our investment pools, there's no minimum commitment. Liquidity. One of the big barriers for individual investors to invest in this asset class is you buy an asset, you've got to wait for it to liquidate before you get your cash back. That can be 5, 10, 15 years. With our investment products, which are evergreen and open in nature, you get ongoing ability to redeem at any time. And return upside. So what are some of the recent trends in private markets? Lots of dry powder. Globally, there's over $4 trillion in cash on hand ready to invest in private companies. Record valuations. Prices are going up. You see this in the public space. This is replicated in the private space as well. Strong demand. As new funds come out, they're getting bigger and bigger and oversubscribed. Lots of demand from investors wanting to get into these asset classes. Smoother ride. What we've seen in the past few years is you get the potential for return upside with private markets with a smoother ride. Less volatility in terms of pricing. Unlike public instruments, which can be factors of emotional pricing, short-term pricing, private markets don't price on a daily basis. And they factor more fundamentals in terms of economics in their pricing. So what are some of the emerging themes that are driving private markets demand? The pursuit of income. In this historic low interest rate environment, and even with interest rates going up in the future, it's still going to be low on a historic basis. So products like mortgages, private debt, infrastructure have great appeal in this asset class. Diversification beyond public stocks and bonds. Investors are demanding this. This is going to continue to drive private market demand forward. Retail participation. This one's probably the most interesting. As I said before, institutional investors allocate greater than 20% of their investments into this asset class. Retail investors have been left out of it. Going forward with product innovation, changes in regulations, we see this being a key demand focus where retail investors will now start to access this class and go from where they are today, which is 1 or 2% allocation, upwards of higher single digits to low teens. So I'm going to give a bit of a spotlight on 2 asset classes. First one being private equity. Activities at record levels. You can see here in this chart, in 2021, US GPs combined deals were $1.2 trillion. That's 50% higher than any previous year. And the number of private companies continues to increase, as I mentioned. More and more opportunities for private equity firms to engage. Multiples, prices have gone up. You can see over the past 10 years, up until recently, prices were around the 9 to 10 multiple point. They're now over 13. A large driver of this has been the technology boom within private equity. More and more deals are going in as technology deals which price at a higher multiple. If you factor that out, the prices are pretty close to the historical average of the 10. So some of the trends to watch for in private equity. AUM has been growing about 11% a year over the past 10 years. We see this trend accelerating in the next 5 years, partly by the demand I just mentioned. We see it going up to 16% potentially in the next 5 years on an annual basis. In terms of some of the themes, will tech still be king? We've seen in public markets tech's taken a downturn. Will that happen in private markets as well? ESG rising. What will be the impact of new emphasis and focus on ESG in private markets? Will sellers continue to be able to dictate price? Will they have this power? And what's the relationship between private equity and private debt, who have both fueled each other's growth over the past several years? Will that continue to play out where private equity can tap into private debt for leveraged finance deals? Now I'll turn to private debt. You can see here on the left-hand side, these are all the different segments within private debt. You've got risk-free T-bills at the bottom left, which earn very little, 0%. Then you've got broadly syndicated loans, which give you a 400 basis point premium over the T-bills. The space we like to play is the red bar, which is the directly originated upper middle market. It offers a 260 basis point premium over broadly syndicated loans, but with less liquidity. But the risk is about the same. And the risk premiums here have been widening. 5 years ago, they're about 150 basis points. Now they're about 260 basis points. And they also protect against rising rates because the majority of these loans are floating rate loans. AUM is also at record levels in private debt. Ever since the great financial crisis, private debt's become a very good category for investors to invest in. It's been growing at almost 12% a year over the past 10 years. In the next 5 years, we see that trend continuing to grow at about 11 to 12%. So what are some of the big macro trends we're watching and monitoring and building some risk defenses for? The first one, obviously, is high valuations. We've got high valuations coming in across both private equity and infrastructure and all the other asset classes. So some things we like to do are we like to partner with strong sponsors, people who have a long-term history of being able to create value creation. We invest in industries that are not cyclical, and we do conservative underwriting. We stress test our portfolios to try and ensure that capital preservation is always top of mind. The second thing is rising rates. What happens if rates start to rise? What's going to be the impact? We've been positioning our credit books to more floating rate and shorter duration to help offset some of the risks that we would normally see in a rising rate environment. And then we also focus on cash flowing businesses and properties. So even if rates rise, these businesses and properties will have the ability to withstand some of that. And then economic cycles. You can never mitigate all of the risk around economic cycles, but what you can do is have a really strong, broad-based portfolio diversified across sectors, industries, even vintages in terms of when we brought in the individual investments. So now I'd like to turn it over to Mark Hanna, our Managing Director of Real Estate.
Thank you, Bijal. And last and not least is I'm going to talk about real estate. Starting with our returns for 2021, I'll start first with the Canadian Income Fund. Last year, the Canadian Income Fund recorded an 18.4% return. This is a great result and more than makes up for the previous year. Last year, we added 19 acquisitions, and there's a number of reasons for the strong performance. Our fund composition for multifamily, self-storage, flex office, creative office, and industrial in these key growth markets, such as Vancouver and Toronto, they really paid off for us. Secondly, our Nicola Wealth Real Estate team, they were able to achieve some outstanding outcomes with rental income growth for our self-storage and industrial assets in particular. And lastly, the cap rates compressed for multifamily and self-storage and industrial. These factors all contributed to an impressive result. Looking forward, we will continue with this strategy on the fund composition in these key markets, and our conservative projection for returns in 2022 is in the 10 to 11% range, which is essentially mirrors our 5-year average. For the U.S. income fund, we recorded 11.5% return for 2021. This is a very respectable result. Last year, we added 17 acquisitions. The revenue growth and valuation increases for our multifamily rental apartment portfolio really kicked in during the last half of 2021. In addition, we have been aggressively acquiring existing and executing on build-to-own for small bay and mid-bay industrial distribution product in key markets such as Phoenix, Denver, Vegas, Dallas, Seattle, and now Minneapolis. Similar to our Canadian income fund, this strategy is starting to pay big dividends as we are now benefiting from strong tenant demand in these markets. We're also building a self-storage portfolio in the U.S., starting with Denver, very similar to our advanced self-storage portfolio in our Canadian fund. Looking forward, we'll continue with this strategy on multifamily with Venterra and with our pursuit of existing and build-to-own industrial product in the target markets. So conservatively, our projection for 2022 is also in the 10 to 11% range, which mirrors our 5-year average. And lastly, our value add fund, we recorded 12.9% return for 2021. This is also a very respectable result. 2021 was a very active year as we added 31 acquisitions for this fund. At year end, 2021, we had 62 projects for a total assets under management of $650 million. And we have another 12 acquisitions that have carried over and are scheduled to close in the first quarter of 2022. We've added some new strategic partners for this fund. We have several existing reliable partners who are also scaling up with on new projects. So looking forward, we have built a great stable of quality partners to help us execute on this fund. There are several key markets we have had success with, and we will continue. We also have had strong results with certain asset types, such as small bay industrial strata, rental apartment buildings, land entitlement, residential condo, just to name a few, and we will continue with this strategy. Our conservative projection for returns in 2022 is a little bit more optimistic as we are targeting in the 13 to 15% range, which is above our 5-year average. Moving on to target markets. Firstly, geography is also very important consideration. We have been strategic in selecting certain markets that either feature low vacancy, strong employment growth, or favorable tax environments. In Canada, we like major markets such as Vancouver, Toronto, and Montreal, in addition to some strong secondary markets such as Victoria and Kelowna. Over time, we see further expansion in markets such as Ottawa, Winnipeg, Calgary, and Edmonton. In the U.S., we have 2 primary focuses. For our partnership with Venterra, for our multifamily portfolio, we are concentrating on the south and southeast markets such as Florida, Texas, Tennessee, and South Carolina. For our industrial portfolio, we are focused primarily on 6 major markets, being Seattle, Phoenix, Las Vegas, Denver, Dallas, and Minneapolis. We're also looking to add more cities over time, such as Salt Lake City, Austin, and Reno. Moving on to asset classes, our focus will continue to be on the assets that have performed very well, such as multifamily, apartment, industrial, flex office, and self-storage. However, there will be opportunities with stress assets such as retail, which we will consider. Another strategy we have adopted over the past few years is acquiring covered land plays. This includes both Canada and the U.S. This is where the existing use provides an attractive holding income in the short term to medium term, but there's a higher calling for the next generation for the property. I call these scruffy real estate in a AAA location. Typically, these include transit-oriented sites that have helped us very quickly build up a large inventory of future development sites while benefiting from strong holding income until we plan for the next generation of the asset. Moving on to the next build-to-own developments, it is very difficult for us to acquire new and shiny product at retail pricing, and that makes those acquisitions accretive to our funds. That's why we made the decision 4 years ago to develop a build-to-own strategy for our income funds. In order to do that, we built an in-house development team to execute on this strategy. Build-to-own allows our Nicola Wealth Real Estate team to create the value, provided you build the safe assets in the right location. You cannot replicate those same returns if you buy new and shiny at retail pricing. The types of safe assets we are building include, no surprise, multifamily rental apartment buildings, self-storage, under our advanced brand, industrial distribution buildings, and single-story or low-rise creative office buildings. As mentioned earlier, we have built up an impressive inventory of future development sites through our covered land play strategy that will provide a large pipeline for many years. With this strategy, we now have accumulated a large land inventory for our development pipeline, but with the added benefit of strong holding income while we plan for the next generation of the property. Moving on to value-add fund strategies. The value-add fund is now in our 7th year, and it's developed a solid track record. This is a pure merchant fund where we either build to sell or repurpose and sell. While the equity multiple is an important and interesting metric, the primary focus is the project IRR, which is time-weighted. This is a good discipline and is how we are measured by our investors. Therefore, time is your enemy if a project takes longer to complete. The value-add fund benefited in the earlier years from some great tailwinds. Then costs started to rise and permits took longer, stressing the delivery date. It's challenging to acquire lands that will take 2 years to put into production due to the permit process. However, sometimes it can still work. Our strategy over the past 2 years is adjusted where we are focusing on very specific developments such as small bay industrial condo, industrial mid-bay for lease, multifamily rental apartment buildings, industrial portfolio in bulk, and land density entitlement. What we have learned in that selecting the right partners is very important to have alignment, and we have been very fortunate to have some very strong relationships with some of our valued partners. And moving on to threats in 22 and beyond. Being paranoid is not a bad thing. It keeps us from being complacent and getting too comfortable. Threats and speed bumps exist in any environment. Not many people anticipated that the economy would recover so quickly in 2021. This included real estate, which rebounded much faster than anybody expected, as evidenced by our fund returns. So we've had some pretty strong tailwinds. However, looking forward into 2022, we do see some threats on the horizon, specifically inflation. This includes materials, labor rising at an alarming pace. Rental rates. Tenants are no doubt in shock over the rapid increase in rental rates on their renewal. Interest rates. We have been spoiled over the last number of years with a record low interest rate environment. Interest rates are due to rise soon. Access to labor. The development pipeline of new projects for all asset types is high, and access to skilled labor is an ongoing concern. We need to do a better job at training. Supply chain. We've taken for granted the easy access to materials and product. This has been compromised as of late with no relief in sight. Municipal government red tape. Approvals for new product is taking far too long. We need a better system to get new supply to the market in a more timely manner. And finally, federal government. Not to get political, but this is probably the most disappointing from my perspective. We need better leadership in our country. Thank you, and now I'll pass you back to David Sung.
And our Q&A session will begin shortly. Thank you. Welcome back, everyone. As I mentioned at the outset, we've been excited for today's presentation, and especially the Q&A panel portion of our presentation today, because we have the three heads of our asset management verticals, public assets, private capital, and real estate on our panel today. And the questions have already started pouring in, so we're going to jump right into it. Mark, given that you just finished off, the first question that actually came in was for you. It is, what is your strategy on investing in Alberta, and what are your preferred asset types?
Yes, the Alberta question. So if people remember back when we first started our real estate funds back in 2003, we started out by saying selecting the markets to invest in. So we selected Vancouver, Edmonton, and Calgary. We thought those were great cities to start with in the West, and we were targeting 10 to 30 million per transaction, and we were looking at office, retail, and industrial. And that's how we got started. And so over the years, as we fast forward, into 2015, we built up an impressive portfolio for all three funds, but in particular for Canada. And at that time, and around 2015, our allocation to Alberta was around 30%. And it was at the same time where the oil and gas industry was starting to experience their challenges. And so we did receive a lot of inquiries from clients concerned that our allocation within that fund was 30%. The assets continued to perform well. It was mostly industrial and multifamily. We did not own any high-rise office in the downtown core. And then as you further fast forward to 2020, when COVID occurred, even though 98% rent collection was recorded for all three funds, and in particular Canada, we actually had 100% rent collection for our Alberta assets. So what that told us is that we bought the right assets in that market, and they were very reliable and durable. Since that time, the allocation now has reduced from 33% range to now 14% in Alberta. And the reason for that is we've been very active buyers in other markets such as Vancouver and Montreal and Toronto, which has naturally brought down the allocation. So if the question going forward is, would we consider buying in Alberta? The answer is yes. We need those markets to succeed. We need Edmonton and Calgary to prosper. And we will continue, and we are currently looking at assets such as multifamily and industrial. We are definitely not buying high-rise office, and we don't do that in any of the major cities in Canada.
All right, that's great. Thanks, Mark. The next question that's come in is for Bijal. And Bijal, you touched on some of the opportunities in private markets, but what would you say are some of the challenges with private market investing?
It's a great question, David. We see a lot of deal flow in our private capital space, and one of the big challenges is when you see these deal packages come in from professional investor relations groups or professional companies, they all look really good. So you need a dedicated team to be able to sift through all of this. You need some patience, and you need to be able to roll up your sleeves and do deep due diligence in order to find the opportunities that make the most sense for your investment.
All right, that's great. Thanks, Bijal. Rob, question that's come in for you. Where are the risks to your forecast?
The biggest risk would be a stagflationary environment. So if you have an environment, and we've seen this in the U.S. with some concerns around consumer confidence turning a lot lower, likely due to inflation and concerns about inflation. But in an environment such as that, when you still have inflation and you have the economy and economic growth slowing, it becomes a challenging environment to manage through, both from a central bank point of view, but also an investment perspective.
Okay. Now, John, don't want to leave you out on the panel being way at the other end of me. Good question that's come in that I think is a bit of a passion area for you. What do you see as the short to medium term outlook for clean tech and renewable energy related investments, particularly in light of energy prices and geopolitical instability?
You know, I remember not long ago somebody explaining to me that the solution to weaning ourselves off fossil fuels was the higher the price would go, the more viable it makes renewable energy sources. But I think people have to be quite realistic. When you especially talk about solar and wind, I was just reading the other day, in Europe, for example, they make up 3% of the energy supply, and essentially relatively unreliable. I mean, we are so far away on battery technology, so most of what we're going to see in renewable is going to come down to how fast the technology can be created, not just to make it more efficient, but also to make it so that it can be stored. And I think another aspect is you have to define what you include in renewable energy. So do biofuels count? Does nuclear count? And those become, I think, very important aspects of it. They may end up, assuming they should be in the mix, a larger part of the mix than, in fact, we're going to get from solar and wind. So I think in the long run, it's going to be a longer-term play for renewables, and how quickly it occurs is going to be a function of the technology that's behind it.
Okay, I'm going to stick with you, John. Question that came in is, can you comment on Africa and its population impacts, maybe just further to some of the demographic slides that you shared during your presentation?
One of the slides, which is from a source called Statista, and it's also supported by the book by Daryl Bricker and John Ibbotson, when they're talking about the population peaking, let's say roughly around 2050, and then declining as the global population declining as it moves towards 2100, that by 2100, the largest population in the world, the second largest population in the world, I should say, next to India, will be Nigeria. And the increase from today is staggering. We're talking a population today of 260 million going to 780 million, basically tripling in a period of 80 years. At the same time, that China's population, which is currently 1.4 billion, would shrink to less than that of Nigeria. So I think obviously from a global influence perspective, Africa is going to increase in importance basically to the rest of the world. The question you have to ask yourself is, will they be able to have that population increase and still increase their standard of living, which has actually been improving at a fairly rapid rate? And that, I think, is going to be the acid test of how important that population growth in Africa is going to be. But it's going to be significantly greater than any other part of the world.
Mark, this is a question for you, but I think it certainly, others can comment on it as well within their respective asset verticals. And it's here it is, on interest rates. Do you have concerns in real estate over the potential for rising interest rates?
Certainly, we always have concerns about a lot of topics, and I think all of us on this panel can agree that interest rates have already started to make their rise. If I'd like for the audience to think back to when we first started our funds back in 2003, we were buying assets that had around an 8 to 9% cap rate, and we were borrowing at a 6 to 6.5% interest rate. So the key theme is the spread. It was 250 to 300 basis points. So today, we've enjoyed that spread as those interest rates and cap rates came down over the years. And so going forward, as the rates start to make their move, cap rates will rise, but maybe not as fast as everybody thinks. And one of the reasons is that there is a lot of capital in the marketplace. And our experience is that cap rates are usually slow to follow the interest rates, but in time they will. But the key for us to counterbalance rising interest rates is what our team can do that's within its control. And so when we look at buying an asset, we look at, has it got good bones? Is it a good location? But are the rental rates at or below market? And that's really the key, because when we buy an asset, we've got to make sure that we can execute and create value with it and grow that revenue. And that growing the revenue is a great counterbalance to rising interest rates and cap rates.
Rob, any thoughts on the fixed income market, especially as it relates to interest rates?
I think it's why interest rates are going up and how quickly they go up. If interest rates are going up because the economy is doing well, then that can be good for risk assets. If they go up too quickly and it has a negative impact on economic growth, that's going to be more of a problem for risk assets. And I think that includes real estate and private assets as well as public assets.
Okay.
Yep, I covered it a little bit in my presentation, but we are focused a bit more on floating rate debt and shorter duration assets, and we haven't been overly exposed in technology, so that would probably be an asset class that would get impacted the most by interest rates going up quickly.
Okay, thank you. All right, with all these challenges and your point of view on different asset classes, in the current environment, what do you see as the proper asset allocation or weighting when diversifying between fixed income, equities, and alternative asset classes? And John, I'm not sure if that might be one, given your involvement with the core.
So in your part of the presentation, David, you talked about the asset allocation mix that we follow. And it's not meant to be rigid, But our core asset allocation, you could break it down into something more or less in these bigger categories as give or take a couple of percentage points, a third in income producing or value added real estate, a third in fixed income, things that pay interest, whether private or public, and a third in equities representing both public and private companies. And more or less, the real approach that we want to take is to continually rebalance into that. So if public markets drop 20 or 30%, then that's the asset class that you're now acquiring when you rebalance. Okay? And the same would be true for all of the other asset classes as well. So as a core portfolio, that's how we would take people's capital and ideally deploy it. But I mentioned to you earlier that each situation with a client is bespoke. So if a client comes to us and they're giving us $2 million to invest, it depends on what other investments they have. If they have, let's say, a bank that they're working with and they have $2 million and it's all in North American equities, we are going to change that mix to reflect that reality of that client. So we want the client to be balanced in all of their investment assets as opposed to just the assets that are with us. But for most clients that have their capital, primary capital with us, what you presented on the core portfolio, that allocation is the one that we're going to target.
Okay. Now this next question, maybe I see it as a combination between Mark and John. I know our clients here in both Vancouver as well as our clients in Toronto, they love their real estate. So the real estate questions keep coming in. What is your perspective on the increasing cost of housing in Toronto and in Vancouver? How is it sustainable? A UBS study indicates that both Toronto and Vancouver are in the top 6 worldwide bubble risk.
Well, I'll let you start.
Yeah, I think you can think about this housing question and the ridiculous price of housing, in particular in Vancouver, but more recently in Toronto. But that question has been on again, off again for the last 40 years. So it's not exactly something that's new. And I think one of the challenges is that Canada chooses to have a relatively aggressive immigration policy, which I think is exactly the right thing to do. And at the same time, there's a concentration of growth that's occurring in 2 cities that have some limitations in terms of the availability of land, in particular in Vancouver. So with those 2 things occurring, it's hard to imagine that you're not going to have ongoing continued pressure as it relates to housing prices. And so it's an interesting question about saying, okay, well, is Vancouver or Toronto, are they both in a bubble? Well, yes. I mean, if you're comparing them to housing prices in Regina, I guess there is a pretty significant difference. But there's a lot of difference in terms of population growth and available land in Regina as opposed to Vancouver or Toronto. So I think I would say that while it wouldn't surprise me to see higher interest rates impact housing prices in both those cities, in terms of a permanent long-term trend, that is to see a long-term decline in housing prices in those 2 cities over the next 10 or 20 years, that's going to surprise me if that happens.
Mark, just before you jump in, because I think I have some thoughts around what you might be saying, there's another question that's come in that might wrap into your answer. It says, as the NDP government in BC has limited the ability of landlords to have term leases and limits any increase in rent, is BC still a good market for residential rental properties?
Well, the answer is yes, because there's going to be more supply that we need to accommodate the growth that's going to happen in the province. But when I look back to when I bought my first home a few decades ago in the late 80s, I look at the down payment that we required to buy our first home in relation to our income. And then I look at it today as my kids are looking to buy their home. It's significantly different and much more challenging. So unless you have the bank of mom and dad to help, it's very difficult for young people to buy that first home. And so one of the reasons we are so active in the rental apartment category in both the US and Canada is because we believe that because it is difficult to get that down payment, people are going to be forced to rent, and they'll take their other earnings and savings into other investments. And so we are big believers that the demand will always be there. Even with rent control, it's still a very safe investment.
All right, thank you, Mark. Unless my iPad is broken, the live stream on the questions seems to have hit a little bit of a limit. So I would encourage all of you to, if you do have questions, don't be shy about entering them. But I've got one more here that relates to our core fund and what its strategy is over the next 12 to 24 months. John, you touched on it a little bit, and I think maybe some additional comments around how actively that has changed outside of, let's say, the one-third might be helpful.
Yeah, I mean, I don't think that we would see any dramatic changes. We generally do gradual changes in terms of the asset mix within core. There are certain things that we have added to that. So for instance, 7 or 8 years ago, we made a decision within real estate to start to look at this, the value add fund that we have, which is a development fund, a merchant bank fund for real estate. And that became part of the real estate mix. So we weren't really changing the allocation to real estate, but we were increasing the depth of the investments that we have in real estate. So that's typically happened. It's certainly happened in private assets with private equity and private debt as well. But I do not imagine that we're going to see big changes in the core allocation. One of the keys to the return in core is the ability for us to relatively easily rebalance on a scalable basis so that we can acquire assets that have dramatically changed in price quickly. And that has been an absolute godsend in terms of the way we've been able to adapt to changes in markets. And we're in a market now that, at least year to date, it certainly looks like we're getting towards correction and potentially bear market territory for some equity. And the question really is, when we finally take a look at how far that goes, we will rebalance and repurchase that kind of mix, that percentage that we want to have in public equities as a result of those kind of corrections.
Rob? I would add to that within the funds themselves, we don't necessarily change the asset mix, but we may change the mix within a fund to encompass our view of what's happening in the market. So in fixed income, we have reduced that over time, but we've also, within the funds themselves, chosen lower duration or shorter term products that are less interest rate sensitive.
Yeah, and that's true also in private assets with mortgages and private debt, David, so that basically the rising interest rates aren't actually going to be a negative result, let's say, for our mortgage fund. In fact, in the long run, it will be beneficial because the actual yield on the fund will increase.
Now I see my appeal to the audience has resulted in more questions, about 5 more questions, all on real estate coming in. I'm going to put a pause on the real estate questions just for a moment. I haven't seen any questions yet, so I'm going to throw this out to the panel. Any questions yet as it relates to geopolitical issues, especially what we know is going on with Ukraine? And perhaps, Rob and John or any of you, maybe just some observations that you're sort of seeing early on that you might be seeing as a result of what's happening.
Well, I think the real thing we see in the market, other than obviously everyone's very concerned from a risk point of view and a humanitarian point of view, but what I find interesting is you're seeing the concerns of inflation not necessarily dissipating, certainly maybe even being ratcheted up with the increase in the price of oil and what that's going to mean globally for inflation, especially in Europe.
Yeah, no, absolutely. Rob and I were talking about this. I think it is interesting, though, to note that one thing one might have thought would have elevated would have been interest rates is actually gone the opposite way. So I think there's a certain fear. This is a flight to safety aspect from an investment perspective. Obviously, markets are very edgy. Some markets are much worse than others. But 10-year bonds in Canada, in the U.S., in Germany, pretty well all around the world have dropped by 30 basis points in a matter of 10 or 12 days. At the same time, as Rob says, that inflation basically is actually rising. So those two things are out of sync with each other. And at some point in time, it's going to be interesting to see how this plays out. That regardless of the fact that obviously the Russians, in theory, should be able to dominate the Ukraine militarily, even if they accomplish that, the idea is that the sanctions could last for months, if not longer. And the impact of the sanctions on things like oil prices and just generally the overall global economy are going to be significant. And so it might, in the long run, mitigate how fast interest rate increases occur. It might make central banks think twice before they make any rapid changes or rapid decisions because of the uncertainty about how this is going to play out.
Yeah, I think it's tough to be a central banker right now. It's a tough spot to be in.
Yeah, agree.
Now, I know we addressed, so two questions on the same topic came in. I know we addressed this during our panel last year, but I'll bring it up again. Thoughts on the future of cryptocurrencies, digital assets? What does that look like potentially in the future? And then the other question added the metaverse to it as well. Ooh.
You don't want to ask me that question. Basically, anybody under the age of 40 is going to think I'm a dinosaur. So the first thing is, I think cryptocurrencies are personally, I think they're a complete waste of time. And they're just purely speculative. And interestingly, I was watching a number of shows about this, and the fact is that unlike gold, they're a sort of a risk on asset. In other words, they perform better when in fact, generally speaking, technology stocks are doing well and the economy is relatively calm. They've done quite poorly during the first part of this year as a result of the uncertainty. Whereas gold, on the other hand, has actually performed pretty well over the last 4 or 5 or 6 weeks. So my view of cryptocurrencies is they're just simply a speculation. They're not income-producing assets. They're just, you're betting on something in terms of the future outcome, and I don't think of that as investing at all. Okay, the technology behind cryptocurrencies obviously is a different story altogether. And while I really don't understand all the aspects of blockchain, my understanding that I have so far is that it's materially important, especially to financial institutions, about where their platforms are going. So I think that part can make sense. But to me, the actual currencies, I think they're a waste of time from an investment perspective.
Well, crypto's not going away. I can't quite convince John to just do a little sliver in the core fund. Yeah. It's really at the early stages for seeing how crypto is used to acquire real estate. So it's not really impacting our world at this point, but it's going to happen. It's only a matter of time. Is it going to be, 1 year, 5 years? We don't know, but it's here. It's going to change over time. It's not making a big impact at this moment in our world.
Bijal, what is driving the increased retail investor participation in private markets?
Yeah, a lot of it is innovation. So a lot of larger companies are now seeing the way we've been going into market with innovative products where you can buy in at lower dollar amounts, you can buy in and redeem them over time if your asset allocation needs change. A lot of larger companies now are starting to see the benefit of the evergreen open-ended model for private markets and are offering that to different individual investors. And I think if you look at the individual investor space, they've typically invested maybe 1 or 2% in this type of asset class. Institutions, as we've seen, are over 20%. That's going to start to move up, and when it starts to move up, it's a big elephant that will come in. The retail investor space is quite enormous, and when people start to buy into it, you're going to see a lot of cash coming into the private market space and newfound demand.
Thank you. Now we've got time for one more question. There are other questions that have come in, and if you'd like, please still keep submitting your questions. One commitment that we'll make is that answers to any unaddressed questions will be posted shortly on our website. But this last question, John, I'm going to lob your way. How does the uncertainty of climate change factor into our long-term, for example, 10-year planning?
Well, it's pretty critical. I mean, at the end of the day, besides there actually being a regulatory or compliance requirement to have an ESG policy as a company, and this is true for all financial institutions, that people are going to make decisions. People are going to choose investment strategies based on the fact that, let's say, they see that there's an ESG component, and the environmental component, the climate change component, if you will, is going to be a very critical issue. The challenge that I think we face, we have a sustainable innovation fund specifically focused on the technology as it relates to both energy and innovation. And the challenge is it's going to be naturally volatile. So in the first year, it earned a spectacular return of almost 60% in 12 months. And in the next 12 months, it had a net drop of around 30%. These are the kinds of changes you typically wouldn't associate with let's say, blue chip public markets. So if people are going to make a decision that they want to focus on things that are really linked to, say, to climate change, to technology, to renewable energy and all of that, they have to accept the reality it's going to have a very high degree of volatility for a significant amount of time. So it's just the cost of understanding that that's, you know, if you feel that you have to have that part in your portfolio. And I would think that, generally speaking, when I take a look at what we already do, I think Mark can speak to the ESG or climate change aspect of our real estate. We have a policy for each area of our investment strategy. And I would say that we're very close to being 90 to 95% ESG across all of our pools. And it will continue to be an important component of what we do.
Thank you. Thank you, everyone. And on behalf of John, Rob, Bijal, Mark, and myself, I want to thank you all for joining us today and being such great supporters of our firm. If you'd like to learn more about our views emerging from 2022, we'll be publishing regular updates on our website, nicolawealth.com, describing our take on trends and what we're doing to address them. And please feel free to contact your advisory team at any point, who will be more than happy to answer any questions you may have. We hope you found our strategic outlook in its virtual format valuable and insightful. Thank you.